The single data point that changed everything. This past week, every economist and analyst was blown away. The United States defied all odds as the unemployment rate declined to 13.3% instead of soaring towards 20%. Instead of millions more being unemployed, 2.5 million Americans went back to work. And America is at its best when its back is against the wall. Here is a chart that shows historical U.S. unemployment, and highlighted in red are the U.S. recessions. Even at 13.3%, it's already higher than any peak unemployment rate during any previous economic downturn. As you can see, unemployment tends to rise as the recession matures. Normally, unemployment peaks just after the recession ends. This lag is caused when citizens try to rejoin the workforce, but not enough jobs have been created yet. So the unemployment rate actually goes up briefly following the end of a recession before decreasing. Whether it's 13.3% or 20% unemployment, the result is still the same. The longest economic expansion in U.S. history came to an end in March. All told, the expansion lasted 128 months. The coronavirus has left no stone unturned, and every economy in the world has felt the virus's impact. GDP contractions were felt around the world in the first quarter. The second quarter will be even worse for countries like the United States, Canada, and the Eurozone. Major economies have essentially ground to a halt for the better part of 3 months. Yet, most major indices are within shouting distance of previous all-time highs. The disconnect between the market and the current state of the economy continues to be at unprecedented levels. Next, you'll see the Dow Jones Industrial Average with the United States unemployment rate below it, and highlighted in red are the U.S. recessions. Remember, the stock market is forward-looking. Investing by looking in the rear-view mirror is a recipe for disaster. So this begs the question, will this be the fastest recession on record? In March, we saw the biggest fall in markets. In 27 days, the Dow Jones Industrial Average fell 37%. It was total carnage, and according to all the talking heads, the world was ending. Then in 50 days following, we've had the strongest recovery ever. The Dow is up 47% from its lows, and those same talking heads are now beating their chests. What you're looking at now is a chart that shows the decline and rebound in the Dow Jones Industrial Average compared to previous major corrections. The highlighted circle is where we are now, the black line. This past weekend, legendary investor Stanley Druckenmiller stated he totally underestimated the rebound and was underinvested. He's not alone. Even the great Warren Buffett misread the situation when he sold off his airline positions at the bottom. The biggest, smartest, and most consistently profitable investors from over the last 40 years are being shown scratching their heads by the media. But they're rich for a reason. They do not chase stocks. Day trading takes over. In the past few months, a record number of retail trading accounts were opened on the Robinhood trade platform. Over 3 million new traders have taken to the market since March. In fact, of households making between $35,000 to $75,000 a year who receive stimulus checks, spending on securities in the stock market increased by over 90%. This was the third largest increase in any spending category, behind only savings and cash withdrawals. Households making between $100,000 and $150,000 a year saw their spending on investing in the stock market trades go up by 82%. This time, second only to money transferred to savings. The demographics of Robinhood traders are similar to those of sport betting, basically gamblers aging between 25 to 34 years old. According to net interest, the median age of Robinhood customer has drifted up from 27 in 2017 to 31 now. Makes sense. And 80% of them are men. With the NBA, NHL, and Major League Baseball all on pause since March, sports gamblers have had nowhere else to turn except day trading with those stimulus checks, which is why you see the media running stories like one Chicago resident flipped his sister's stimulus check into nearly $10,000. And one 26-year-old Robinhood trader made $1,500 in less than 24 hours betting on a beaten down airline stock. Now, I ask you, does this sound normal to you or sustainable? When a company like Chesapeake Energy soared from $14 to $77 in 2 days on major retail day trading, this company has over $18 billion in debt. It's trading at 5 cents on the dollar. Think about that. The debt is trading on 5 cents on the dollar. Who do you think is smarter? The guys who own the debt, who are first in line, or the equity gamblers? Let's recall here. It went from 14 to 77 in 2 days and back to 16. It's absolutely critical that you do extensive research on a company and not just watch the ticker or what the media heads are talking about, or else you'll be left holding the bag. Meanwhile, at Katusa Research, subscribers and I built 2 new positions in their top tier companies during the crash, and we're up big. We did miss my target on 2 other great gold companies by pennies, but we've just scored another plus 215% gain on a junior non-producing gold stock. Look, if I was to rate myself, and I used to be a teacher, I'd give us an A- for our performance. Like my hardworking European immigrant father said to me growing up, regardless of how well I did, you could always do a little bit better, Marin. When our monitors and systems start alerting our team that retail traders are going nuts on precious metal stocks, that will be our cue that the top is near. But for now, the best days in commodities are coming if you know what you're doing. The US Federal Reserve has 2.8 trillion reasons to hope that the bottom is in. And at the global level, there are over 9 trillion reasons to hope that the worst is behind us. Of course, the reasons I am referring to is the cumulative amount invested by the central bankers and governments to keep the economies from total collapse. Now, the word invested or stimulated or injected, those are all subjective. The $9 trillion question is this: does the US unemployment data point represent an inflection point for the economy, or is it a one-off blip on the screen? It's important to consider that this is a single data point. I believe we need several more data points before we can truly connect the dots and project the type of recovery we'll be seeing. 2 important factors I'm looking at are the labor market conditions and consumer spending habits. Knowing the types of businesses that are doing the hiring is also very important to understand the real strength of the economy. How much value is being created through this rehiring process? I think we could see a quick restart of initial hiring by businesses who are cashed up and ready to go back. It'll be a long, difficult road for those businesses less fortunate. Consumer spending habits will also be a key data point. I am hesitant to believe that discretionary spending habits will immediately go back to where they were 4 to 6 months ago, pre-COVID. The laid off or recently rehired individual isn't going to go out and buy a brand new flat screen TV, a fancy car, or go on vacation to Vegas. This could very well be the summer of staycations. That's why I believe a swoosh-style recovery is a possible option. An economic recovery that starts quickly and then slows down before grinding higher over time. How do you invest at this point in the recovery? US Fed Chairman Jerome Powell said he'll expand the Fed balance sheet to infinity if he needs be and keep interest rates at 0%. On top of that, as I mentioned in last week's video, yield curve control, YCC, is likely to become a tool in the Fed's toolbox moving forward as the Fed tries to wrangle a hold on interest rates. This bodes very well for gold. A tsunami of cash is a tremendous catalyst for stores of value like gold. This makes gold stocks highly attractive. At the same time, this cash fuels economic expansion, which needs base metals and oil, not to mention funding the green dream and ESG movements. It's worth noting that I think the activity in the US dollar over the past 4 months truly demonstrates that the US dollar will remain the world's reserve currency. The demand for dollars was virtually unlimited during the crisis. You couldn't say the same thing about the yen, euro, or the won. It may come as a surprise to you, but the US dollar has actually increased its share of global payments. The US dollar currently makes up over 42% of global payments, up from 40% in 2017. That is what you're looking at the screen right now, the blue bar charts. Here at Katusa Research, I'm positioning myself and my subscribers into unique opportunities that I believe have substantial upside. One of my latest gold stock recommendations just made a massive deal to acquire an incredible asset earlier this week. This gold stock shot up over 300% since our entry price. What you're looking at right now is how the Katusa gold portfolio has held up versus its peers since the start of the year. We have outperformed every single comparable index. If your precious metals portfolio is not up significantly in the last couple of months, or if you're finding that you're not getting the best information on commodity market action every month, consider learning more about my premium newsletter. A secret I'll share with you is that it really comes down to backing the absolute best people. I've spent 2 decades as a professional investor and fund manager. I've built relationships with the who's who of the industry. I've flown over 1 million air miles and visited over 100 countries. You cannot replicate that type of experience in a short period of time. I'm truly excited for the next chapter of this market. We've had an incredible start to the year, and I think the second half could even be better. Stay healthy and safe.